Are you a new stock investor, want to avoid common mistakes? The journey of investing is filled with potential pitfalls and learning experiences. It's a winding road where each turn can lead to profit or loss. Understanding common mistakes is vital. It can prevent you from falling into traps and help you navigate the financial maze with more confidence and ease. So, fasten your seatbelts and grab your notebooks. We're about to embark on an enlightening journey. Let's dive into the first mistake that new investors often make. Mistake number 1. Panic selling. This error in judgment is as old as the markets themselves. A prime instance of panic selling was during the 2008 financial crisis. Investors, gripped by fear of a collapsing banking system and a looming recession, hastily sold off their stocks at significant losses. Those who succumbed to panic and sold their holdings locked in their losses. On the other hand, investors who stayed put eventually witnessed a market recovery. Remember, panic selling often leads to locking in losses. Mistake number 2, overconfidence. This is a big one, folks. Let's jump back in time to the late 90s, the era of the dot-com bubble. The internet was new, exciting, and filled with endless possibilities. Investors were swept up in the hype, pouring money into tech stocks with the belief that the internet was going to revolutionize business. And why wouldn't they? The returns were fantastic, until they weren't. When the bubble burst in the year 2000, those supposedly invincible tech stocks plummeted, and the overconfident investors who had put all their eggs in the tech basket saw their substantial gains wiped out. Why? They hadn't diversified their portfolios, a crucial safety net in the investing world. This is a classic example of how overconfidence can blind you to potential risks, leading to significant losses. Overconfidence can lead to significant losses, especially if you don't diversify your portfolio. Mistake number 3, chasing hot stocks. It's easy to get caught up in the excitement of a soaring stock like Tesla Inc. Back in 2020, Tesla's stock price rocketed skyward and many investors jumped on board, buying at peak prices. But what goes up must come down. Periods of volatility followed, and those who bought at the top experienced losses. The lesson here? Chasing hot stocks can lead to buying at peak prices and potential losses. Mistake number 4, lack of research. Remember Enron Corporation? It's a glaring example of what can go wrong without thorough research. Many investors were lured by its apparent success, failing to comprehend its intricate financial dealings. When the company's accounting fraud came to light in 2001, the stock nosedived, becoming worthless. The result? Massive losses for those investors who skipped doing their homework. The lesson here: always dig deep into a company's fundamentals before investing. Lack of research can result in substantial losses. Mistake number 5, ignoring diversification. Picture this. The year is 2008 and the financial crisis hits. Some investors have their entire portfolios heavily invested in banking stocks. As the financial sector crumbles, so do their portfolios. If they had diversified, spreading their investments across different sectors, they could have cushioned the blow. But alas, they put all their eggs in one basket, and that basket was dropped. Ignoring diversification can devastate your portfolio. Mistake number 6, short-term focus. Imagine a day trader, eyes glued to the screen, buying and selling stocks with every market fluctuation. This high-frequency trading may seem exciting, but it comes with a hidden cost. Each trade triggers brokerage fees and potentially short-term capital gains taxes, chipping away at the profit. The thrill of quick wins can overshadow the reality of these costs. In the end, a short-term focus can lead to excessive trading costs and taxes. Mistake number 7, lack of a plan. Let's consider a scenario, a hypothetical investor who decides to dive headfirst into the vast ocean of the stock market without any strategic blueprint. This investor might be swayed by every new headline or hot tip, buying and selling stocks on a whim without giving a thought to their long-term goals or risk tolerance. Imagine this investor leaping from one trending stock to another, treating the stock market as a game of musical chairs. They might strike gold once or twice, but without a clear plan, they're playing with fire. Their investment journey becomes a roller coaster of highs and lows, with the potential for significant losses. A strategic plan is not about predicting the market's every move. It's about setting realistic expectations, understanding one's risk tolerance, and having a clear sense of one's financial goals. Without it, investing can become a dangerous game of chance. Lack of a clear strategy can lead to costly mistakes. Mistake number 8, ignoring fees and costs. Just like any other service, mutual funds and ETFs charge for management. These fees might seem small on the surface, but over time they can nibble away at your returns like a relentless woodpecker. Imagine a mutual fund that charges a 1% management fee. That may not sound like much, but over a decade, that 1% could eat away thousands from your investment. Ignoring fees can significantly erode returns. Mistake number 9, not learning from mistakes. Imagine an investor who, after losing money on a speculative penny stock, decides on a more cautious approach. But alas, they fall into the same trap again, failing to learn from their past error. It's like touching a hot stove not once but twice. This repetition of mistakes is a dangerous loop that can seriously impede financial growth. Wisdom isn't just about acquiring knowledge, it's about applying that knowledge to avoid past pitfalls. Repeating mistakes can hinder your financial growth. Now that we've covered the common mistakes new investors make, it's your turn to avoid them. Let's quickly recap. Don't fall prey to panic selling. Stay calm and remember, markets recover over time. Avoid overconfidence, which can lead to a lack of diversification and significant losses. Don't chase after hot stocks, as this can result in buying at peak prices. Ensure you do your due diligence and research before investing. This will save you from potential pitfalls. Don't ignore the importance of diversification. It's your safeguard against market volatility. Maintain a long-term focus and have a clear plan. This will help you stay on track. Be mindful of fees and costs, as they can eat into your returns. And most importantly, learn from your mistakes. These are essential steps to successful investing. Remember, knowledge is power. Avoid these mistakes to make the most of your investments.